Today's guest is Stephen Clapham, founder of Behind the Balance Sheet and one of the best independent voices in investment analysis today. Stephen, you spent over 25 years as a professional investor, including at multi-billion-dollar hedge funds. You've built out Behind the Balance Sheet into a fantastic platform. You've written a phenomenal book, The Smart Money Method, How to Invest Like a Hedge Fund Pro. You're all over the media. You've been featured in the Financial Times, the Times, Bloomberg, Odd Lots. But more importantly than all of that, you are here today. So thank you and welcome.
Well, thanks for having me. I'm excited to talk to you, and I'm looking forward to it.
Absolutely. I mean, let's dive in. An amazing career so far. Just talk me through it. How did you get to Behind the Balance Sheet? Tell me everything that built up to that moment.
Well, how long's the podcast? Because I'm very old. No, I ended up in the city really by accident. And, I started in the South Side. Then one of my clients asked me to go and work for them. And I thought, why didn't I do this earlier? Because I really enjoyed being on the buy side. And I set up Behind the Balance Sheet as a training consultancy in 2018. I mean, I did various things in between. It was really an idea that how do you put your experience to good use?
Yeah.
Right. So training was something a friend of mine suggested, and I started off doing one-to-one coaching. I then was asked by Russell Napier, put me in touch with Stewart Investors who were looking for a forensic accounting course. Okay. And he said, could you build us one? And so I thought it was quite an interesting project. Yeah. So I went and locked myself away in the British Library for about 6 weeks. I completely blew the budget. But you know what it's like when you get interested in something.
Yeah.
And I thought, it was quite an interesting project because I'd never done anything like that before. I never built a training course before. Yeah. So I thought, how do you go about doing that? So I sort of researched the training courses, and then I thought, okay, so forensic accounting. I mean, I'd done a bit of forensic accounting, but I wouldn't call myself a forensic accountant. Other people called me that, but I don't really consider myself that. But the idea I had was, let's look at frauds because they're the most extreme example of companies cheating.
Yeah. And
so if you get the extreme examples, it brings it all home. It's much easier to understand. And so I studied probably 70 odd frauds, sitting in the British Library, looking at all these stuff. And I found it really, really interesting. And so I built this course, and the course has been incredibly popular. I mean, thankfully. And I mean, my clients, I don't know, I'm allowed to say all of them. I mean, some of my clients are, some of the biggest and most successful hedge funds in the world, people managing tens of billions of dollars. And so I now do 3 things. I train professional investors now to be better at analyzing financial statements, reading 10Ks and so on. I've got an online school, which is 50% professional, 50% private investors. And our main product is a course called Analyst Academy, which teaches you everything you need to become a serious investor. And we've got a professional version of that for people that are wanting to get into the industry to become an analyst. And then the third part is the podcast. So I've got a popular podcast and a Substack. But again, it's quite interesting. This was something that I didn't want to do. So Substack approached me and said, why don't you write a weekly newsletter? And I remember having the conversation with Linda LeBrun. I said to her, Linda, all these years, I've never written a weekly publication. I've never even written a monthly sector publication. I did one monthly publication for a short period to help another team. But no, I mean, it sounds like the worst possible thing. And she said, how about we pay you? Okay. And I said, how much? And so we had a conversation, and they paid me a publication advance. And I thought, let's have a go at it. And what's very funny about this is that the thing that I was dreading, I now really enjoy.
Okay.
So which is it's quite an odd thing. Once you start getting into it, of course, what I was worried about was that I would come in the Monday morning and think, oh, crikey, what am I going to write about this week? And I'd be, I thought it'd be terribly pressured. So before I started, I made a list. I think it had about 70 different topics that I could write about. And it was all listed in a spreadsheet. I don't think I've ever looked at that spreadsheet. Because I've always, you come in the morning and you think, oh, actually, you know what I'm going to write about? I know what I'm going to write about this week. So I've been writing recently about the hyperscalers CapEx, because I think people haven't really understood the full ramifications of that.
And how much of that is off balance sheet?
Yeah, well, the very interesting that, you would imagine that it's a very obvious thing. If you're a professional investor, you're a professional financial analyst, you would imagine that you would spend a lot of time reading annual reports, because there's a huge amount of information, particularly in the United States. The 10K's got a huge amount of information. Well, I'm afraid that people don't do it, right?
Well, you'd be surprised how many people on the buy side don't have a model for a company that they own a significant amount of. You'd be surprised how many, you can't really get away with it on the sell side, but on the buy side, just rely on the management relationships. It's like, oh yeah, I've spoken to them, things sound good, won't bother to read the 10K or won't bother to read the annual report. It's kind of worrying.
Particularly from doing the podcast, you learn that people have very different ways of managing money.
Yeah.
And, the people I interview in the podcast are pretty successful investors.
Yeah.
And, they have a very, very different approaches. And it's not for me to say, oh, you must have a model. I know lots of people that don't have models in all their stocks. But I do think that reading the annual report, the 10K, is kind of a basic price of entry to a stock. And I'm not saying that every private investor should read the 10K or annual report cover to cover for every company they own. But if you've got a significant position in something, it's really helpful discipline to read the annual report and try and understand the business a bit better, because at the end of the day, what you're buying is an income stream.
I've got two things to say to that. I think one is, I think there's a skill to reading annual reports, because a cynic might say that they are just an exercise in marketing a company's stock. And so you do need to read it with a critical eye. And I think two is, AI surely makes that, that price of entry, as you put it, into a stock way more affordable in time as a currency for ordinary retail investors.
Yeah, I'm kind of old-fashioned, right? So I'm not saying that, the AI can't do it for you. Maybe it can for certain people, maybe it can handle certain basic functions. I remember having a phone call with my number one client, which was the most successful hedge fund in London. I can't now remember why I called up, but I was having a chat with my counterpart, the analyst in the transport sector. And I said, so what are you up to? And he said, oh, I'm putting in the British Airways traffic figures into the model. And I said, why are you doing that? I'll send you my model. He said, I've got all the data and I can guarantee you it's all 100% accurate. And he said, no, I don't want to do that. I said, well, why not? He said, well, I want to look at the numbers. And, Mark Rubenstein wrote in his column a few weeks ago, he was talking about Claude and its ability to produce a forecast. And he made some comment. I think I made a comment in my book that I found it quite therapeutic putting the numbers in. And the reason I do it is not because I enjoy it. The reason I do it is it forces you to look at every single number.
Yep.
And what I found is that process and that discipline means I don't miss anything. But the reason that I've done that isn't because I enjoy it. The reason that I did that when I was a professional investor was that I was doing deep dive special situations research. We were taking very large positions in companies, and we didn't want to make a mistake.
I'd love to dive in a bit more on Substack. I think what strikes me is you're a planner. So you started with courses and you thought, right, I've been asked to do this course. I'm going to look at 70 frauds. It's going to take me 6 weeks. You then have Substack approach you, and even if you didn't come back to it, you put a list of topics together before putting pen to paper. Can you maybe just share a little bit about what it was like starting Substack? And what I mean by that is, how did you find your voice? How did you decide who you're writing for? And is that voice the same voice that you bring to the Behind the Balance Sheet podcast?
Well, I've got a very distinctive voice, as you can hear. But I haven't really designed anything. I've just said, what do I find interesting?
Yeah.
And it's the same with the podcast. I've never sort of gone and done any market research to say, what do you want to listen to? I just produce stuff that I want to listen to.
Yeah.
And I write stuff that I think is interesting.
And dog food.
It doesn't appeal to everyone, right? I mean, I think I'm number 75 in finance on Substack, right? So I'm not,
Well, I mean, that's nothing to be sniffed at. It's 22,000 subscribers. That's a massive achievement. And you're doing that, by producing content that you think is interesting, that you believe is relevant, eating your own dog food.
Well, I think when I started with the podcast, I had this idea that I had a really interesting, fulfilling, rewarding, financially rewarding as well, career as an investment analyst. And I thought, I'd like to inspire other young people that this is a thing worth doing. And I didn't really set out to do that with the Substack. I mean, I set out with the Substack, I thought, Substack are paying me.
Yeah.
And I better write some stuff that people will find interesting. But I didn't say, I'm going to set out to write a thing to teach beginners how to invest, because I think there's lots of people that do that and do it quite well. And I don't have any particular skill in doing that.
Yeah.
So I guess my aim was more the professional investor or the serious amateur. But, I write about quite a wide array of subjects. I mean, I've written extensively, for example, about private equity, because I thought, all this nonsense about private equity you got a couple of years ago, that, the returns were, bound to continue, and, they were all geniuses. And I wrote a piece. I remember there's a report produced by Hamilton Lane, patting themselves in the back, saying, we're all so smart. And I almost wrote a parody of it. I said, well, actually, you're not so smart, and this is what's going to happen. And the private equity, in my view, doesn't have a hope in hell of making its historical returns. And all those endowments have stuffed their funds full of private equity funds. They are going to be in serious difficulty. And the switch to private credit, I mean, we're seeing the business development companies starting to get redemptions. But the Blackstone fund had a net one and a bit billion of redemptions. It had $2 billion of new money. And I'm asking myself, well, who is giving them this? Because it's patently obvious. And, there's nothing new in investing, right? Bitcoin apart. But there are no new concepts in investing. And when you get a lot of capital chasing a particular sector, it usually creates overvaluation. When you get a lot of capital chasing credit, the inevitable result is that credit standards fall and defaults rise. And, the private credit market hasn't been remotely tested because we haven't had a normal economic downturn. Well, Terry Smith in my podcast said that he didn't reckon we'd had one since the 1990s because the dot-com boom and bust was a particular focus in that sector. So, maybe we're in a world where we never have a normal cyclical downturn and the central banks are all geniuses. But I can tell you that I very much doubt that.
So it's interesting because you're saying you've called the top. It's interesting because you call the top of private equity, you're calling the top of private credit, or sounding the alarm at least.
I'm not calling the top. I mean, the private credit operators, they're very smart and they're very good at kicking the can down the road.
Right.
But you can only kick the can down the road for so long.
Fine.
Eventually, the fundamentals will come home. And I mean, it's blindingly obvious that when private equity started, there wasn't much capital. There were a lot of badly run companies that they could buy very cheaply and fix and sell and make high returns. Now, and on the way, valuations were rising because interest rates were falling. So they could load up with debt, and the debt cost less as they progressed. Well, now we've got relatively low interest rates. So I don't know whether interest rates are going to go up or go down. That's a big question. But we've got relatively low interest rates, so the potential for interest rates to fall much further and improve valuations is limited. Valuations are already high. A lot of bad companies have already been fixed. Companies are generally making higher margins and higher returns than they were 20 or 30 years ago. So just the opportunity set is more restricted. That on its own would be a difficult backdrop. But at the same time, you've 10x, 100x the amount of capital chasing it. I don't know what the numbers are, but I'm sure it's over 10 and probably not as much as 100.
I guess, so two immediate thoughts there. One is, come back to what you said, there's nothing new in investing, or principles at least. That feels not dissimilar to the public equity market, right? Retail investors can only really get their hands on stocks once venture capital, private equity have had their fill and looking for a big liquidity event to, crystallize their gains. So yes, again, the opportunity set, I take all of that on board. And you can probably argue a similar case for public markets because companies are staying private longer, et cetera, et cetera. And so
Well, I've got a slightly different view on public markets. Just to round off on the private markets. I mean, I wasn't really including VC in that classification, right? Because VC's a very different class, and some huge opportunities there. But again, you've got the same phenomenon that it used to be a very limited amount of capital chasing the deals. There's now a lot more capital chasing them. So that of itself is a cap. But public equities, I think, is a very different phenomenon. And in public equities, there's a sort of general perception that equity markets go up 8% per annum, and they'll do that forever. Yeah. And I mean, that has been true over a very long period, but it's been true over a very long period, punctuated with periods in which markets have not done well for an extended period. I don't want to discourage any of your listeners or viewers from investing in equity markets, because I think investing in the equity markets is a good thing. But you might not make 8% per annum for the next 10 years because we've had...
Well, certainly not in the US.
Certainly not in the US. We had a very, very strong period, right? And that means that returns are less likely to be as good. Valuations start high, and valuations dictate your 10-year returns. Okay. So I'm not anticipating that 10-year returns in the US will be anything like what they've been in the last 10 or 15 years. UK actually looks quite cheap, right? So
it's cheap for a reason. Oh, it's always been cheap. Well, not always, but it's been cheap for about 10 years, and probably for a reason.
There are pockets of the UK which remain, and the UK has done pretty well last year, right? And but there are pockets of the UK that look extremely cheap to me. Yes. And I don't think I've ever had as much UK exposure in my portfolio as I have today. Okay. Right. I mean, I've generally not been an investor in the UK over the last, 20 years. I mean, and on my way here in the tube, I bought some more UK positions, or I topped up UK positions. I think UK remains very cheap. I mean, this isn't investment advice, right?
No, of course.
I mean, but my personal view is that when everybody's running away, that's where you should run to, right? And UK has been derided for years, and I think, maybe it's not, its time has come, maybe it's not going to explode, but there's some pretty good companies in the UK at pretty reasonable valuations, and you don't get that everywhere.
Yeah, I guess I would. Well, I think you've shared your perspective. I guess the alternate approach, or maybe a more cautious approach, is being willing to wait longer, miss out on the first 10 or 20% to be confident that others see value, rather than go in and wait. And granted, last year was strong in the UK, so maybe that's now rather than a year ago.
Well, but I think that, you touched on a point I think is really of fundamental importance. So that, people always like to catch the bottom, right? And that's a very difficult thing to do, right?
People like to think they can. I just think it's...
Well, when I was working at the hedge funds, we were running a lot of money.
Yeah.
So you can't wait for things to bottom. You have to buy them on the way down, right? Because otherwise you just can't get enough. And the problem with that is you don't know where the bottom is.
Yep.
So you're buying them on the way down, and guess what happens? They keep going down.
Yep.
And that is a very uncomfortable situation. And, the number of times that we'd bought something and it carried on going down, and then our trigger for a review happened. These are very uncomfortable situations because, of course, you don't know when it's going to stop. But you think you've identified an opportunity, but you're being measured quarterly, monthly, weekly.
Yep.
And every week the thing falls further, and every week it detracts from your performance, and every week you're suffering more pain. And it's a very uncomfortable situation to be in. But you don't have a choice if you're trying to deploy billions of dollars of capital. If you're a private investor, well, who cares if you miss the first 10%?
Yeah.
That's a lot easier. You're much better off waiting for the thing to bottom and bounce. And, when you think that your thesis is proven, then get in then. I think that's a much more sensible philosophy. I still buy things on the way down.
Force of habit.
Personally. Well, I'm not a full-time investor, right?
But also, you maybe you're moving billions.
I wish I were, but the issue is more just one of time, right? I'm not spending 60, 80 hours a week looking at stock markets, watching share prices, and I'm thinking, oh, well, that's actually quite a good idea. And now that I'm thinking about it, and I've got my phone, I can trade now, and whether it falls another 10% or not, I'm not really bothered because I'm investing long term. I don't know how long I've got, but
So it's interesting. You've drawn out some of the comparison there between institutional investors who have that time limit in that performance, bonuses, inflows, job security all depends on performance over a period. And as a private or retail investor, you've got essentially forever by comparison. Does that impact, and sort of switching gears a little bit to your training approach, does that impact how you deliver courses to an institution versus a private investor?
Well, not really, because most of my professional clients are pretty fundamental, pretty long term. Obviously, I've got a lot of hedge fund clients. I've got a shorter term performance horizon, and we do tweak the content a little bit to reflect that, because they're much more concerned about quarterly numbers and that sort of thing. But I think, my mindset is always that the longer the time horizon, the more chance I have of deploying my skills more effectively. So if you ask me, is stock X going to be up or down tomorrow? I've got no idea, right? I literally have no idea. If you ask me over a week, well, I might say, well, we're in the middle of a war and what's going to happen to the market? And I might have some clue. But again, the chances of me being able to predict that correctly aren't much more than 50%.
Yep.
If you ask me about a 12-month view, well, I've got, I can then start to stack the odds in my favor. And, I don't need to go after every opportunity, right? I can stick to those opportunities where I feel that the odds of me predicting that 12 months out are high. And when you go 12 months, 18 months, 24 months, I mean, that to me is a sweet spot where your analytical skills can predict an outcome much better than 50%.
Yeah.
And I don't really make a distinction between whether you're a retail investor or whether you're a professional investor, because if you've got that kind of time horizon, and I'm not talking about, having a 10-year view. I mean, I'm full of admiration for these investors that I meet or I interview that say they've got a time horizon of forever, and they want to hold the stocks for decades. I mean, fantastic. I'm not that smart, right? I mean, if I think I have a reasonable stab at where things will look in 2 years' time or 3 years' time. But beyond that, there's the world's a complicated place, and I'm of the view that you should optimize your opportunities at the time, right? So in 3 years' time, will I continue to want to hold this stock forever? Probably not, right? I don't really make a distinction between institutional and retail, and my time horizon is really like a couple of years out, because that's where I think you can predict with a reasonable degree of confidence what's going to happen to the company's earnings.
Gotcha. Well, speaking of forecasts, or in this case, specifically not a forecast, but a scenario, the Citrini research piece from February looking at an AI future. What did you think when you read it, and how do you, as a private investor, think about sort of those risks? Or is the answer that you don't, because it's so far in the future it probably doesn't matter, and it's almost certainly wrong?
I thought that what they tried to do was an admirable endeavor, right? And I thought it was quite a clever marketing tool, actually.
Yes.
And what I thought was quite interesting was the reaction that it raised, right? I mean, it's very unusual to see a research report create that amount of stir. Were they accurate? Were they right? I mean, it's a thought piece. I mean, that's the way I read it. And just to say, well, what could happen? And I mean, nobody's got a clue what's going to happen, right? I mean, I was sitting there yesterday listening to Gary Channon of Phoenix talking about, his views on AI. Well, Gary's an extremely thoughtful investor, and he's spent a huge amount of time looking at AI and how they can deploy it in their own business, and how it will affect the companies they own, and how it will affect companies in the future. And they're pretty smart. They haven't had a stellar track record in the fund in the last few years, but they've got a pretty good long-term record. And I've got a lot of respect for Gary's research process and the way he approaches things. And he said yesterday, he identified, for example, Rightmove, and he said, Rightmove is at risk of being displaced by AI agents, and their customers hate them. So, yeah, I get that, but if you're trying to sell a property today and you're not on Rightmove, the chances are the seller is not going to give you the transaction, right? So, and all due respect to Gary, I mean, I understand his argument in this respect, but will that be displaced? Because what you're trying to displace is the mindset of a consumer, an ordinary person looking to sell their house and asking, well, when I look for houses, I look on Rightmove. So if the estate agent isn't on Rightmove, I'm probably going to go somewhere else. At what point does that change? Well, I'm sure you could create a set of APIs that extracted data from every estate agent, and you could build an alternative to Rightmove.
Well,
but you
look at all the alternatives that have come and gone.
Yeah. But there's quite a lot of consumer spend that advertising you would need to displace that.
And Rightmove has 500% cash returns, so on cash invested, and so they've got the cash to fight back.
Absolutely. So I think it's much more nuanced. So a very simple thing. So the stock market is kind of voted with its feet. It's cut the shares in half. And you could understand why it's done that. But will Rightmove still be around in 5 years' time or 10 years' time? I think it's a brave conclusion to assume that it won't.
Yes.
Right? I mean, it's perfectly possible, and it's perfectly possible that it won't be able to charge what it's charging today, so that its margins will come under pressure. That's certainly possible. But at the end of the day, I think it's a very difficult thing to predict. And obviously, if it's difficult to predict and they're making very high returns, making very high margins, there's a risk that those will erode. So it's unlikely the stock market will give them the benefit of the doubt as long as there's that overhang. But with, I'm just looking at a micro-focused thing in the UK. But, you start to spread this out. And, I mean, it's very difficult, I think, to understand what's going to happen.
Yes.
And if you look at, say, the software industry, SaaS, I mean, I think generally speaking, there's been a huge amount of fear that all these things are going to get displaced very quickly. And I think that misunderstands the consumer's role in this. If you're a company and you're using a Salesforce CRM, it's going to take you a long time before you throw that in the bin.
Yeah.
Right? And the alternative will have to be extremely slick. And, that assumes that Salesforce isn't going to respond. I mean, it's a very large company with a lot of resources that has the ability to respond.
And just to add to that, I think a lot of SaaS platforms, and Salesforce is a good example, people have sprawling relationships, but people buy these things to not get fired, to put it simply, right? If your sales team underperforms and you are not using Salesforce, you're in trouble, because why aren't you using Salesforce? It's Salesforce, it's the best. If you're using Salesforce, you go and find another reason. And you're going to have to unpick that, and entirely possible AI gets rid of those people anyway. But you're going to have to unpick that behavior and people looking after themselves in order to displace those large incumbents.
It's an incredibly complicated subject. We don't know where we're headed to. We know that AI will displace a lot of jobs. We don't know how. I mean, I think, Gary again yesterday, he made the point that in an ideal world, he would just be able to displace his research team with AI.
Yeah.
But he's quite a long way from doing that. And if anything, what he's doing is he's using AI to make the research team more effective, more efficient, and so they can cover more stocks.
Well,
right?
That's the JP Morgan approach.
Yeah. So that's not exactly, negative for employment, right?
No.
But it's clear that jobs will go, and there will be, jobs. There will be, departments with. He used the example of a department. You got 10 people, and 2 people plus AI could do the same job. But he said the problem is that you've got 10 people. The 2 that you need to work with AI aren't in the 10, right? But that's a very common sort of situation.
And you probably have to pay them more, so you're paying the equivalent of 8 people.
So the problem you've got as an incumbent is you've got these 10 people, and you would rather have 2 people plus AI, but you need 2 different people, and it's quite a difficult transition to make.
Yeah.
You can't just fire the 10 and hire the 2 and hope that business continues. So it's much more likely in those sorts of situations that you'll be displaced by a new entrant, because a new entrant can just go and buy 2 people and give them the AI.
Yeah.
So I think there's going to be a lot of dislocation, and that's very messy and very difficult to predict the pace, because how quickly will that new entrant be able to display?
Exactly.
And I mean, I think it's quite exciting because it's quite interesting to see how all this will pan out. And obviously it'll be very different in very different industries.
Mm-hmm. So we attended a conference put on by Google and Beehive not too long ago. And when they were looking at the rise of video content, what struck me was, yes, short form is really important, but long form is also really important. And you've almost got a barbell of the types of content people like to consume. And that seems to be the case in written content as well, right? You've got really short form content, especially when it comes to news, but you've obviously produced regularly 3,000 plus word long pieces. You've got Citrini bringing more traffic to Substack that no doubt you'll benefit from. I guess, how do you think about the dynamics there in terms of content length and striking the right balance?
Well, I don't really know what the right balance is. I mean, you know, those really long pieces, I don't think anybody reads, right? I mean, going back to when I was a professional investor, I used to take home 3 or 4 80, 100-page, 200-page books that people had written. I just used to think, well, what looks interesting in this pile? And, I used to flick through them. And I mean, I never read one cover to cover. I mean, never.
Well,
and
20 of those 100 pages would be disclaimers. So
well, probably. But, I always thought it was quite interesting that somebody had gone to the effort of producing an 80-page note. They must have done some work to write 80 pages. Now you don't need to do any work to write 80 pages. So I don't set out to write a 1,000, 2,000, 3,000, 4,000 word article. But usually what happens is I start off and I think, oh, actually, I should make that point and I should make that point. And my stuff ends up being longer than ideally it probably should be. And because I'm on a weekly cadence and I don't spend the whole week writing my Substack, I probably should edit it down more and try and make it pithier and better.
Can I ask, if you shorten things down, do you think people would feel shortchanged?
I don't know. I mean, I've never really surveyed my audience. I probably should. Do you think that it's better to read something that's longer or shorter? I think if you ask most people, they would prefer it to be shorter.
They'd all say it's shorter, yeah.
But if you're paying for something, then there's kind of actually, he's at least written 3,000 words. There might be 2,000 good words and 1,000 bad words, but at least he's written 3,000 words. Yeah. I don't know what people think. The way I do it is I write quite long pieces, and I use quite a lot of data and charts, and that was always my habit when I was on the sell side. I would basically write a research note by producing a set of charts and tables, and then I would literally paste them in, and then I would write around them. Yeah. I don't do it exactly like that with the Substack, because often I'm exploring something that I don't necessarily know about. But I did a thing the other day. I did 2 pieces on Formula One. I think they've both been published. Certainly the one on the profitability of the Mercedes Formula One team has been published. And then I did a thing on the other teams. And I did this just out of curiosity. And it turned out that when I started to get into it, that there was this kind of weird result that the introduction of the cost cap made everybody much, much more profitable. Because before they were getting the sponsorship money and spending it all. And it was kind of it's kind of obvious when you say it, but until you look at the data, you don't know, right? Yeah. And so those sorts of things, I would actually go through. I wouldn't start writing until I'd built the spreadsheet and produced all the charts. Yeah. And, that was literally what I did. I produced all the charts and I then said, well, what are the charts telling me? And I wrote around that.
And that comes to the point of telling a story, right? You're not trying to just make a point. If your charts tell the story and you're writing to that story, then if you end up at 3,000 words, every word is worth it. and it's not lit for the sake
I
of
mean,
it.
you need to ask the readers.
Well,
everywhere. I don't know. I mean, I just try and do my best to write something each week that people will find useful.
Yeah.
Because I think that's my job, is to, people to go away thinking, well, I learned something from that.
Yeah.
Or I found, maybe not I learned something, but I thought that was quite interesting, or I thought that was quite helpful.
So, Steve, what's the most ridiculous financial headline you've come across this week?
This week?
Or ever?
Or ever. I mean, I've seen some amazing headlines in all these decades, but you've just prompted my memory. And my favorite headline of one of my research notes when I was on the sell side was I wrote this note and I said, don't open this. I can't remember what I said, but I said something like, don't open this note. Don't even turn the page. That's right. I said, don't read this note. Don't even turn the page. All you need is this chart.
Oh, wow.
And it was just a chart showing, and this particular valuation parameter, the stock had bottomed. And it was a very consistent, very accurate valuation parameter to predict the ranges of this stock.
Yeah.
And I published that note, and my number one client called up, and they not called me up, their dealers called up the dealing desk. And the dealer came over to me, and he'd almost wet himself with, he'd never had such a big order, and he couldn't execute the order.
Oh, no.
It was quite funny. But yeah, that was my favorite front cover of a research piece. That don't read this note, don't even turn the page.
Stephen, it's been fantastic having you here. Thank you so much. Before we go, please let everyone know, where can we find you online?
Well, I'm very easy to find. The website is behindthebalancesheet.com. If you want the Substack, you hit the sign up button in the top right corner. And there you can also find our courses for private investors, our online courses, and our courses for professional investors. And the podcast is available wherever you get your podcasts.
Fantastic. Brilliant.
Thank you.